Welcome back to Citi Market Watch. This is episode 11. Welcome back, Audrey Cheong, Citigold Private Client Portfolio Counselor. I have to say, Audrey, markets have been frothy and volatile, and it really looks like there is more to come. This is like learning to surf. You're off your board, getting pummeled, and the waves just keep coming. And as John Maynard Keynes famously said, markets can remain irrational longer than you can remain solvent. Audrey, what's top of mind for this episode?
Thanks, Sun. Debt ceilings, the FOMC, we need to frame expectations with some objectivity. And of course, it's always good to highlight where clients or investors can look to build on opportunities.
I remember when the S&P downgraded US debt back in 2011. It was the first time a negative outlook was issued since the S&P began its rating in 1860. But let's go, Audrey. Frame for us what the US debt ceiling is and why the US is where it is now.
The debt ceiling is a man-made US problem. Now, it is a legal limit instituted back in 1917 to rein in federal agencies who were ignoring Congress's constitutional power over what the government could spend. So whilst the US Treasury, headed by Janet Yellen, oversees bond issues and overall debt management, Congress to this day imposes a ceiling on how much money can be borrowed. As of last month, the US national debt was a not insignificant 28.5 trillion US dollars.
Wow, that's certainly way more than US GDP. But we know the US is grossly indebted. It has run annual deficits since President Clinton's years, and raising the debt ceiling has typically been a routine affair or chore. Why do we have this impasse or potential impasse now?
Well, for political reasons. Congress of both parties agreed to suspend, not raise the debt ceiling for 2 years. Essentially, they didn't want it to be an election issue. It meant that both the Trump and Biden administrations could initially pursue their fiscal stimulus packages without worrying about the debt limit. But the 2-year suspension ended on 31st of July, and so now the debt ceiling is back in play. The US Treasury continues to fund the government through what is known as extraordinary measures. That is, amongst many cash management options, it could, for example, temporarily hold back contributions to government pension funds or draw down on holdings held in the Foreign Exchange Stabilization Fund. Extraordinary measures occurs until US government cash flow is finally exhausted. This is the so-called X date. Son, why doesn't Congress just raise the debt limit?
Thanks, Audrey. That's the million-dollar question. The frustration with the US continues to be political. Democrats make the point that the debt ceiling reflects money already spent. That is, normal government funding, pandemic disaster relief, etc. And hence, as has been the case for most of history, it is just a procedure to raise the debt limit. Republicans, however, note that Democrats do control both houses of government and are looking to push through President Biden's ambitious Build Back Better $3.5 trillion US dollar budget through the budget reconciliation process. Essentially, Republicans want to force Democrats to raise the debt ceiling because they can, subsequently forcing them to state a new, bigger debt ceiling number. Coming into the midterm elections, this would be strategically beneficial for Republicans to pin excessive or irresponsible spending on the Democrats. Audrey, what has history taught us?
Well, expectations are that this will be resolved because, remember, this is a self-inflicted issue. As we have seen in the past, once government services start shutting down, there is a lot of pressure for Congress to act. In 2013, the US came within 48 hours of the X date and an actual default. Short-term treasury bills got sold off and yields rose. As we have highlighted before, given loftier equity valuations, uncertainty around tapering, taxes, stimulus, and decelerating economic data, continued volatility should be expected. Remember, focus on quality.
And whilst we're getting distracted by all these headlines, commodity prices are back at cyclical highs. Everything from Brent crude, coal, natural gas, even uranium and corn. These all add to the broad headwinds to economic growth. Audrey, what are the highlights from the recent FOMC statement and comments from Fed Chair Jerome Powell?
Well, the Fed FOMC statement reinforced a more hawkish stance, stating that tapering may soon be warranted and noting the Fed's dot plots reinforced rate hikes with median dots through 2022, 23, and 24, rising by 25, 100, and 175 basis points respectively. Now, the market response was to see a flatter twist to the yield curve as the market looked to price in a more aggressive taper and tightening with 6 hikes by the end of 2024. And this flattening of the long end does coincide with expectations for slower growth. With the Delta variant, we have seen 2021 US growth expectations drop from 8% to 5%, and the terminal growth through to the end of 2022 and beyond at 2% or lower.
Thanks, Audrey. Let's pivot to some happier ideas. In between our various updates, we have highlighted the importance of trends and thematic investing, like EVs, healthcare, Asia, and all the excitement of disruptive technologies, EdTech, FinTech, MedTech, Health Tech, Green Tech, and Remote Tech. Audrey, what's the interesting glue that cuts across all these themes?
That interesting and exciting glue is millennials, those born in the 80s through the middle of the 90s. Now, we are in the midst of a big shift from the baby boomers and Gen X to millennials and Gen Z. But the millennials cohort of 2.3 billion is the largest population cohort in history, and they're moving into the prime of their lives, earning more and having very different views on how they want to live their lives and spend their money. And they are very conscious about sustainability, focus on enjoying experiences and less on consumerism, status, or owning physical things.
Suddenly, I'm feeling very old, but I certainly can relate. Who really wants or needs a Porsche when Grab is just easier, cheaper, and less stressful? You would rather spend that money on an adventure in Greenland, skiing or sushi in Japan, Oktoberfest, a wombat farm stay in Tasmania, or a yoga retreat in Bali.
A yoga retreat in Bali?
You bet, Audrey, coupled with raw organic food. And I wear only baggy Lululemons. Citi analysts categorize beneficiaries of experiential commerce into 4 categories: entertainment, educational, aesthetic, and escapist experiences. And the thought or philosophical difference is not a transactional good or service, but a transformation. Like how great and wonderful you feel after that yoga retreat in Bali. Audrey, what impresses you most about this gluey millennials cohort?
China continues to impress. Millennials and Gen Z equate to 550 million. China's Gen Zers alone are 251 million cohort, which is basically 3/4 of the population of the US. And they are far more educated, wealthy, and digitally savvy than ever before. Now, China's brands have been driven by this generation. 10 years ago, for example, Adidas and Nike were the largest and arguably aspirational brands in China. But today, we see local brands like Anta and Li-Ning commanding market share and leading on trends. And from the explosive growth of spicy mala to tea and bubble tea, the influence China millennials have is very apparent. My kids and friends are drinking Genki waters and Hei teas.
Thanks, Audrey. There is just so much happening and to appreciate. In summary, you could and should get excited over singular themes like renewables, EVs, fintech, or genomics. But understanding millennials, the biggest population cohort in human history, and how it glues and drives the momentum across these themes is key to truly appreciating and getting fully rewarded from these investment allocations and strategies. When you think about volatility, remember that volatility and risk are very different. Risk is really like going to the casino, and you will probably lose your money. Volatility is simply the characteristic of different asset classes and how susceptible their prices will gyrate. Expectations around the Fed and the debt ceiling will add to volatility. As things get volatile or dislocated, see their opportunities for what they are. For more information and opportunities, please contact your Citigold or Citigold Private Client Relationship Manager.